Kia ora, and welcome to the CoreLogic Property Market Update for Paenga Whawha 2022. Almost every measure is now clearly showing the growing weakness of the Aotearoa property market as listings continue to rise, sales continue to slow, and value change is more consistently dropping into the negatives. With widespread acceptance that the market has changed and that the downturn is already here, many eyes are now turning to any regional differences across the country and where things are headed. With significant affordability constraints inextricably linked to tighter and more expensive credit, it's the areas which experience the greatest upswing in values out of sync with income growth that are now more vulnerable to greater falls in values. This will include some of the more provincial and rural towns. However, our main centres will not be immune. According to the latest CoreLogic House Price Index, Dunedin, Hamilton and Wellington have all experienced noticeable drops in recent months, but the slowdown is more subtle in Christchurch. Further value growth in Tauranga may reflect the greater equity base of a city with an older population which is less reliant on regular income or credit. Meanwhile, Auckland has experienced mixed results across the broad spectrum of property types, locations and values of a city its size. But for now, the tailwinds appear to be outweighing the headwinds. An analysis of preliminary sales data indicates that declines in housing values are likely to be more substantial than the index reading. Listings being reported as mortgagee sales have also started to pop up, though at this stage appear to be limited to unfinished development sites. FOMO-driven overpaying of potential development sites, paired with quickly rising building costs and a higher cost of debt, have likely caught some developers out, especially those that were operating on tight margins. Though widespread vulnerability of the development industry is not being talked about yet. Finalised mortgagee sales are still very low, with only 6 in the first quarter of the year. Though with greater pressure on mortgage payments looming, this may well be the low point. We know banks tend to work with the borrower to avoid going down this path, however, and with labour markets still strong and borrowers being tested at higher interest rates, a strong and persistent increase in mortgagee sales still seems unlikely. While we're considering the potential downside of the market, it's worth acknowledging that anecdotes of doom and gloom in news stories are becoming more prevalent. So, while the global financial crisis provided a very different backdrop for a market fall at the end of the 2000s, as it's the last time we saw values drop, it's almost inevitable we make the historical comparison. Perhaps most interestingly, while property values only dropped 10% from peak to trough, it's not often recognised enough that the recovery back to peak took a full 5 years to occur at the nationwide level, and much longer for some areas. Perhaps then, consideration this time shouldn't be on how far values fall, but for how long do they stay down. One group seemingly happy to see values drop are aspiring first home buyers. And while some may be consciously holding out for lower prices in the future, it's likely that the recent drop in first home buyer activity is due to the reduction in low deposit lending and stricter regulation around checking expenses because of the changes to the CCCFA. First home buyer share of purchases in March dropped to 21%, their lowest share since July 2017, aside from the April lockdown in 2020. Confirmation of the loosening CCCFA requirements proposed to change in June will please those that feel they've fallen foul to the rules. However, it's unlikely to bring a wave of new borrowers or instigate another growth phase on its own. Interest rates are probably a more important factor, and with the Reserve Bank of New Zealand recently opting for the shock factor of a 0.5% increase to the official cash rate, taking the cash rate to 1.5%, they have chosen to go hard early in the need to head off inflation and inflation expectations sooner rather than later. The implications of this decision are clear, with the Reserve Bank reiterating their forecast for the OCR to exceed 3% by the second half of next year. Further mortgage rate increases will follow. This will only reinforce the housing market slowdown that has now so obviously arrived. Of course, with unemployment low and interest rate buffers as mentioned earlier, we think conditions are still in place for a soft landing rather than a serious downturn. In part, this is because in terms of credit availability, the past few months may well be looked upon as the low point. After all, some banks have reportedly reopened pre-approvals and with it increased low deposit finance, while the relaxed CCCFA requirements will also allow more lending to be done. There's also no sign of investors fleeing the market. While total advertised stock levels are well above previous years, this is still due to a slowdown in sales rather than an uplift in newly listed properties. If anything, March was a weak month for new listings, potentially impacted by Omicron and either sick or isolating agents, as well as potential vendors. So highly motivated sellers still appear to be absent from the market. To keep on top of all the latest developments in the property market, make sure you subscribe to our weekly Property Market podcast. and regularly visit research news at corelogic.co.nz for all our detailed commentary. Stay safe, mā te wā.